Good evening, everyone. Very good evening, everyone. I can see students are waiting in the meeting already. Okay, good evening. Um, Welcome back to one more session, one more interesting session of capital structure in the lecture series of ICAI. So, what we have done till now is we have covered the topic of capital structure to some extent, and now we are going to take it a bit forward in the form of some capital structure theories, which involve discussion around debates, capital structure debates. Now, what are we really debating about? So let's get started without wasting much of our time. What do we mean by this capital structure theory, or what is the debate that we are really talking of? So let me just clarify it, what we are really talking about. Suppose there are two companies. By the way, we are covering right now capital structure theories. Okay, capital structure theories. So what is the debate all about? We're saying, suppose there are two companies, X and Y, okay? And both the companies, both the companies are having, let's say, same business operation. The companies are having same business operation, same line of business, same set of customers, same type of elasticity of demand, and everything almost is similar. Obviously, if the businesses are same, if the customer base, type of customer, products, and everything is same, the EBIT also should be same depending on the investment that has been made. Okay, so EBIT is same for both the entities. Total capital employed is also same for both the entities. So now, where is that point of difference? Where is the point of difference that we are going to discuss? Well, the point of difference lies in the capital structure base. Point of difference actually lies in the capital structure. Now, what's the point of difference? Let's say one of the companies, X, is 100% equity funded. Company X is 100% funded by equity, whereas company Y, it is funded partly by equity and partly by debt. Now, it can be in any ratio. It can be in 50-50, 80-20, 30-70, whatever. But there's a difference in the capital structure. We are looking at the fact that capital structure is different for both the companies. One of them is 100% equity, and the other is partly equity and partly debt. Right? Now, the debate that we are talking of is what will be the market value of companies? What will be the market value of both companies X and Y? If the capital structure is different for both entities, but the total capital employed, the business, the EBIT, and everything is same, what will be the resultant impact on the market value of the companies? Will it be same for both the companies, or will it be different for both the companies? Is the market value of the companies going to be same for both, or is it going to be different? That is what we are debating here right now. Okay, so we are debating whether the market value of the company is going to be same for both, or is it going to be different? Okay, so now that's what we are, looking at a typical debate. There are some entities, some business, some financial economists who say that the market values of both companies will remain same. There are some say that there may be the values are going to be different. So now how do we look about this debate and what is the point of debate that we are talking about? Before that, we need to understand what do we mean by the market value of the company, right? What do we mean by value of the company, or what do we mean by value of equity share, value of debenture? So for that, if I ask you, uh, according to you, what should be the value of any asset? According to you, what should be the value of any asset? Value of any asset, remember guys, it's always going to be present value of its future cash flow. Value of any asset is going to be present value of its future cash flow. You name any asset, the value is going to be determined in this similar way. Like for example, if I say there is a, you know, let's say a share of a company. Uh, you know that in year zero, in year zero, uh, you need to purchase it by paying some value. But then I want to know what should be the value of this share in year zero. To get the information that in year one, suppose the value of the share can sell this share, let's say for 1,100, and you will also get a dividend at the end of first year of rupees, let's say, yeah, 30. Suppose you're likely to get a dividend of 30 rupees. So if you purchase the share today, let's say you'll be able to sell the share after 1 year for 1,100, and uh, you'll all when you are before you sell the share, you'll be also receiving a dividend of 30 rupees. So total cash flow that you have in year one is 1,130. Now, what would you like to pay for this share? What would you like to pay for this share today? Because what we essentially say is 1,130 is the value or is the cash flow that you're going to receive in year one. What will be the cash flow in year zero? If you want to say that 1,130 will be the cash flow that will be received in year one, how much would you like to pay for the share today? How much would you like to pay for the share today? Sir, it depends on my required return. Now, let's say your required return is 13%. Considering the risk of the share, you say that I need 13% if I want to invest in this share. If I'm investing in this share, I need 13%. 1,130 is going to be the cash flow from the share after year one. Today, how much would you like to pay for it? Obviously, sir, I would like to pay 1,130 divided by 1.13. We are simply following the formula of future value is equal to present value into 1 plus I raised to n. So it means present value is future value divided by 1 plus I raised to n. Present value will be future value divided by 1 plus I raised to n. So when we say in year one, what should be the value of the share? That is simply going to be 1,000. Because if I need 13% return, I will be ready to buy this share for, if I need 13% return, I'll be ready to buy this share for 1,000 rupees, because after a year, that share is going to give me a return of 1,130. So this is the rule that we are following as of now. Value of an asset. Value of an asset is going to be present value of the future cash flow. To take the name of any asset, guys, you can value the asset by following this simple rule, that value of the asset is present value of future cash flow. Okay. Correct. So present value is 1,000. Everyone got it, right? Okay, it's fine. So let me just take it forward. So if we are talking of value of any asset, it's a present value of future cash flows. Now let us look for what should be the value of an equity share. Value of equity shares. value of equity shares will be present value of future cash flows to equity shareholder. Value of equity shares will be present value of future cash flows to equity shareholders. Now tell me, what are the future cash flows that a shareholder is going to receive? What are the future cash flows that a shareholder is going to receive? Yeah. What are the future cash flows that a shareholder is going to receive is? Okay. Future cash flows that a shareholder is going to receive. Dividend, correct. Right. So any shareholder you say is ultimately going to receive the dividend. So can I say it means, and we are saying that equity shares are not going to be redeemed as such. They are not going to be redeemed within foreseeable future, right? Because they are going to exist forever till the company exists. So present value of future cash flows, can I say it is present value of future dividends, right? Now, if I say if it's present value of future dividends, and I say that there is 100% dividend payout. Now, suppose if there is 100% dividend payout, can I say it will be present value of future net profit for equity shareholders? Now, if I give you one more assumption that uh, there are no preference share capital, or there is no preference share capital, can I say it is going to be same as present value of future profit after tax? Because if you just try to visualize the income statement, it is nothing but present value of the income statement. It ends with PAT, and then you have preference dividend, and then you have the net profit for equity shareholders. So if you are assuming 100% dividend payout, it means the value is going to be equal to present value of future dividends will be same as present value of future net profits for equity shareholders. And if you say there is no preference share capital, then of course whatever is your profit after tax, that itself turns out to be your net profit for equity shareholders, right? So when we are talking of value of equity, it is value of all equity shares. Value of equity, it means it's going to be value of all equity shares. Now, value of all equity shares will be, say, value of all future profit after tax. And of course, I'm going to discount it. Value of all future profit after tax discounted at cost of equity. Because cost of equity is what is the required return for an equity shareholder, right? We're going to discount all our future PAT using K. It means the value of equity is PAT for the first year divided by 1 plus K plus PAT for the second year divided by 1 plus K square plus PAT for the third year divided by 1 plus K cube. And then it just goes on till perpetuity, right? Now, as we are saying, since retention ratio, we're taking it as retention ratio is 0. We are assuming that retention ratio is 0. Growth will be B into R. It means 0 into R. So growth is also going to be 0. It means a PAT, we are assuming that PAT is not growing at all. It's the constant figure that we are foreseeing every year, right? So we can say that PAT for the first year will be same as PAT for the second year, will be same as PAT for the third year, and so on and so forth, right? So You can simply say, let me name it as just a figure as that. So what can we say about value of equity? Value of equity will be PAT divided by 1 plus K plus second year PAT is also same as first year. So PAT divided by 1 plus K square plus again PAT divided by 1 plus K cube plus PAT divided by 1 plus K raised to 4, and this goes on till perpetuity. If we just try to solve this, we'll get PAT common outside. Inside what we have is 1 upon 1 plus K. Yes. So if you take PAT common outside, we have 1 upon 1 plus K plus 1 upon 1 plus K square plus 1 upon 1 plus K cube and so on till perpetuity. Can you tell me what type of series is this? What type of series is this, guys? Evan? What type of series is this? What type of series is this? Geometric series, correct. It's a case of geometric series in which, if it's a case of geometric series, so we have a first term and we have a common multiple. What's the first term over here? First term is 1 upon K, 1 upon 1 plus K, and the common multiple is also 1 upon 1 plus K. So the summation till infinity of these terms is going to be A upon 1 minus R. So if it's A upon 1 minus R, you can say this is PAT multiplied by A is 1 upon 1 plus K divided by 1 minus 1 upon 1 plus K. That is PAT multiplied by 1 upon 1 plus K divided by 1 plus K minus 1 upon 1 plus K. So that is simply PAT multiplied by, you can observe that 1 plus K gets cancelled, and what we have is only 1 upon K. Then we have PAT divided by K as the final answer. What can we really say about value of the equity, guys? Value of all the equity shares of a company is going to be equal to profit after tax divided by K. Now, on the similar lines, just like for equity shareholders, we said it is profit after tax is the cash flow for the equity shareholder. So that divided by K. Similarly, if I say what should be the value of debt, value of debt will be interest upon KD, interest upon cost of debt. Value of the firm as a whole, how much is it going to be? Value of the firm, the entire business is going to be valued at value of equity plus value of debt. Because remember, if I want to buy the entire business, I should have ownership over the equity shares and I should also have ownership over the debentures of the company or the debt of the company. Similarly, value of the firm, if I look at the cash flow perspective, it's going to be EBIT because this is the cash flow which the company is generating for all its stakeholders. So it's going to be EBIT divided by KO, which is the overall cost of capital. Value of the firm is EBIT upon KO. Value of equity, remember this four formula, guys. Value of equity is PAT upon K. Value of debt is interest upon KD. Value of firm stands as value of equity plus value of debt. And the value of the firm Overall, you can also say another way is get EBIT upon KO. Is this clear, guys? Everyone, fundamentally, are we good with this? Yeah, we're just getting the simple valuation rules. If you want to get the value of equity share, simply take the profit after tax, divide it by cost of equity. Okay. And if you're looking at value of debt, simply take the interest and divide by cost of debt. Similarly, if you want the value of the entire business, entire firm as such, you will take it as value of equity plus value of debt, and the value of firm will be EBIT upon KO. Okay, fine, guys. Now, let's come back to the debate that we were talking of. The point was, does capital structure affect value of business? So we were looking at, does capital structure affect the value of the business? It means, as we have discussed in the very start of the chapter, that if there are two companies with same business, same EBIT, same capital employed, total capital structure is only different where one company is fully equity funded, other company is funded partly by equity and partly by debt. Is the value of the companies going to be different or is it going to be same? So from here we have two set of theories that come up. One set of theories say yes, the capital structure has an impact on the value. Second is no. It means no impact of capital structure on the value of the firm. No impact of the capital structure on the value of the firm. There are two set of theories, as I said, and each of them there are propositions. One approach is net income approach, which comes in favor of the proposition that yes, capital structure is affecting the value of the firm. That in the net income approach, we say capital structure does have an effect on the value, and there is another impact where we say no, capital structure is not affecting the value. So that is the target or the next theory is net operating income approach. In the first case, that is where the theories are saying yes, the capital structure is getting affected or capital structure affects the value of the business. We have a traditional approach, and similarly, in the second set we have Modigliani-Miller approach. Modigliani-Miller approach. This is without taxes, and same Modigliani-Miller becomes a first set of theory if it is considered with tax. By the way, the first set of theories, these ones are said to be theories of relevance, whereas this theory are said to be the theories of irrelevance. Why this is said to be theories of why this is said to be a theory of relevance? Because the conclusion of this theory of relevance, is that capital structure does have an effect on the business value. Whereas the second says it does not have any effect on the business value. So there are two set of theories. One is the set of theories called theories of relevance, and other is the theories of irrelevance. So theories of relevance are those theories where they are in the favor, they are in the favor of business values. They're saying the value of the business is affected by the capital structure, whereas the second is capital structure does not have any effect on the value of the business. Okay, so these are the 5 theories that we are going to learn in this chapter. Net income approach, net operating income, traditional approach, Modigliani-Miller, and Modigliani-Miller with the taxes. So let's get started with the first theory. Okay, the common thing is how the PAT will be same for each year. That is an assumption over here, students. Because any theory you say it has to be within the 4 walls of the assumption. Because if PAT is increasing, we can definitely say that the value of the company is where the PAT rate is higher, that will be higher, whereas the PAT rate, where the growth rate is lower, the value will be also lower. Okay, so that's an assumption that we are looking at. So right now, let's have a look at uh, the first approach, which is said to be the net income approach. Net income approach. Now, in net income approach, the first thing is first assumption or first point where they prove their point that capital structure is going to have an impact on the value of the companies. They say cost of debt is less than cost of equity. Tell me, guys, is this point correct or not? Is this point stated by net income approach? Do you agree with this or you don't? Do you agree the fact that cost of debt is lower than cost of equity? Yes, right? Because debt has got a lesser risk. Debt as a capital investment has got a lesser risk, whereas equity shareholders face a greater risk. And of course, because of that, they need to get a higher rate of return also. Now, the second point that we say is increase in weightage of debt will lead to increase in overall cost of capital. So, if your weightage of debt is increasing, overall cost of capital is going to decrease. We say if there is an increase in weightage of debt, the overall cost of capital is going to decrease. Right? Let's just prove it over here. Can I say overall cost of capital is computed as weight of debt into cost of debt plus weight of equity into cost of equity. So increase in rate of debt, they're saying that it will lead to reduction in overall cost of capital. So for that, we are looking at this typical formula of overall cost of capital. Overall cost of capital is the weighted average cost of capital, which is weight of debt into cost of debt plus weight of equity into cost of equity. Let's look at the case whether how this really materializes. So let us say company has got some debt and equity. Suppose a company has got initially zero debt and entire 10,000 is equity investment. What will be the weight of debt and weight of equity? Weight of debt will be 0, weight of equity will be 1. What will be cost of debt and cost of equity? Cost of debt is, let's say, 10%. Cost of equity is, suppose, 15%. Now, what can we say about overall cost of capital? Weight of debt into cost of debt plus weight of equity into cost of equity. That's the overall cost of. So here we can say it's just 15% because that's 0 into 10% plus 1 into 15%, which was. Now, in the second scenario, debt is, let's say, 1,000 and now equity is 9,000. Suppose you bought back 1,000 worth of shares and you replaced it with 1,000 of debt. Now your weightage is 0.1. Cost of debt remaining same, 10 and 15%. So now your cost of capital, overall cost of capital, if you take a weighted average, that is 14.5. In case of debt, let's say now the third scenario is 5,000, 5,000, wherein we are saying weightage is 0.5, 0.5. Cost of debt and cost of equity is 10% and 15%. And if you take the average of both, that is 12.5%. In the fourth scenario, debt is, let's say, 9,000 and you have an equity of 1,000. So now the weightages are 0.9, 0.1. Cost of debt is 10%, cost of equity is 15%. And if you take a weighted average, that is 10.5%. What can you say about the pattern of the weightage of debt? We observe that as the weightage of debt increases, as the weightage of debt increases, what is happening to the overall cost of capital? The overall cost of capital is just getting reduced. If your weightage of debt is increasing, the overall cost of capital is reducing. Right, guys? So this is what was the second proposition, and this seems to be correct. Now, the third point, or the conclusive point, where they say that your value is getting affected by the overall cost of capital, or value is getting affected by the capital structure. They say decrease in cost of debt will lead to increase in company value. You can just see how they are linking with each other. First, they stated cost of debt is less than cost of equity. Then they stated that since cost of debt is less than cost of equity, as you increase the weightage of debt, you're increasing the proportion of those capital which has got a lesser cost, and therefore it will lead to reduction in KO. That is what we observe. Now they're saying as your KO is going to reduce, the value of the firm is going to increase. So let us say KO values we have considered it to be like 15%, 14.5%, 12%, and 10.5%. Now, be whatever the combination of your debt and equity be, whatever be the combination of debt and equity be in your books, ultimately value of the firm is going to be EBIT on KO. You can have any combination, your EBIT is not going to affect it, because when the customer buys goods from you, he or she is not concerned about how you are funding your business, whether you have funded your business by debt or you have funded your business by equity. So in the first case, let's say EBIT is 1500, 1500 divided by 15%, you can say the value of the company is 10,000. Whereas as you move to the second case, it is 15,000 divided by 14.5%, that's 10,344.83. Then 1500 divided by 12.5%, that works out to be 12,000. And in the last case, suppose 1500 divided by 10.5%, we get this as 14,285. What we observe is as KO reduces, value of the firm increases. As KO reduces, value of the firm increases. Got it, guys? So if that is the situation, the conclusion says that if there is a change in a capital structure, if there's a change in capital structure, that is going to lead to change in value of the firm. If the capital structure is going to change, the value of the firm is also going to change. So a chart that is prominently seen in the textbooks, you'll find that cost of debt remains constant, cost of equity remains constant. But what happens is that the cost of capital, overall cost of capital, it reduces with leverage. When you say leverage, what do you mean by leverage? Leverage means you are reducing the overall cost of capital along with the increase in weightage of debt. So as your weightage of debt increases, overall cost of capital reduces. Okay. Is clear? Okay, obviously there are certain assumptions that we're talking of, that KD has to be lesser than K, which is a commonly accepted norm, because KD is less riskier. The business, if you're investing in a debt instrument, there you have a lesser risk as compared to your investment in a equity instrument. Okay, so this was the first theory, which was net income approach. Now let's go for the next theory, which is net operating income approach, which is a challenge to this net income approach, or it identifies some problem in the net income approach and it comes out with its own different version altogether. So let's have a look at the next theory, which is called as the net operating income. And this is net operating income approach. In the net operating income approach, first point on which they argue is cost of debt is less than cost of equity. This is same point as the net income, which is a very valid point, that cost of debt is lesser than cost of equity. Second point on which they are stating their observations is, they say as weightage of debt increases, as weightage of debt increases, what is going to happen? As the weightage of debt increases, can I say KO decreases? That is what we have observed in the net income approach. But that's just one side of the story. Tell me, as the weightage of debt increases, as the equity shareholder, as the company takes more and more debt, will the expectation of equity shareholders remain same? Are the equity shareholders going to expect the same 15% which they were expecting earlier when the company had no debt? Of course, no, because as the company takes debt, the risk for equity shareholders increases. As the company goes for more and more debt funding, can I say risk for the equity shareholders increases, right? Correct, guys. So a side effect emerges from this, in which we are going to say that expectation of equity shareholders increases due to higher risk. So expectation of the equity shareholder increases due to higher risk. As the risk increases, equity shareholders are also going to ask for higher return, and that will lead to KE increase. That leads to KE increase. Now, as the KE increases, what happens is KO also increases. So on KO, there is a pull and a push. There's a pull and a push impact that is happening on KO. On one side, your KO is increasing due to increase in weightage of debt. Whereas on the other side, your KO is decreasing because of increase in the weightage of debt. Whereas there is another upward pull on KE, because KE increases, right? KE increases, and that leads to your overall cost of capital being increasing. So what is going to be the net effect on both these items? So there is a downward pull as well as there is an upward pull. So in effect, the KO remains constant. So this side effect of increase in the shareholders' expectation was not captured in the net income approach. The net operating income approach, we are considering that, and we are saying that KO is remaining constant. As KO remains constant, you will find, let me just show it by way of an example. Suppose originally weight of debt and weight of equity we had 0.1 and 0.9, and at that time, That time we have cost of debt and cost of equity is 10% and 15%. And then you have KO as weight of debt into cost of debt plus weight of equity into cost of equity. So that initially, if you just multiply these numbers, 0.9 into 15% plus 0.1 into 10%, that works out to be 14%. Not 14, it's 15%. So now let's say weightage of debt is 0.5, KD 10%, but what will be the expectation of equity shareholders? Of course, equity shareholders are going to have a higher expectation because of greater amount of debt. And let's say that the equity shareholders expectation is 19%. You will find that overall cost of capital is still remaining same as 15%. Weightage of debt is, let's say, 0.9, and now weightage of equity is, let's say, 0.1. Cost of debt is 10%, and cost of equity, obviously, since a very huge amount of capital is consisting of debt, equity shareholders are going to require a very high return of 55%, and that will cause the KO to be, same as 15%. So, as we say, the final concluding thing will be, as KO is constant, value of firm also will be constant. As KO is constant, value of the firm is also going to be constant, right? And you can say change in capital structure has no impact on value of the firm. You can say chart typically looks like this. The cost of debt, and we have the rising cost of equity. So this is the total cost of KO, and this one is KD. KD, KO, and KE. We find that overall cost of capital remains constant because there is a downward pull from the lower KD and also upward pull from the higher KE. And that's the concluding part for this, wherein say that as the capital structure is changing, the value of the firm is not affected. It remains same. This is your net operating income approach for you. So when debt increases, why shareholders' expectation increase? Because as the debt increases, the risk for the equity shareholders increases. And if risk for the equity shareholders increases, the shareholders are going to ask for a higher return. Because high risk, high return is a simple fundamental. Okay. Why is this called net operating income approach? Well, net operating income approach because just like your net operating income is basically your EBIT. As the EBIT remains constant, the value of the firm is remaining constant, and therefore we are following the net operating income. So even if you change your debt or equity proportion, that's not going to have an impact on the value of the firm, just like EBIT. If you change your debt and equity, like if you get more and more loan or if you fund your business by way of equity, is that going to have any impact on the EBIT? No, of course, no. So if it's not having any impact on EBIT, if it's not having any impact on EBIT, value of the firm is also working in a similar line. As the KO is constant, value of the firm will also remain constant. And therefore, we say that this is a net operating income. The earlier one was called as net income approach because due to debt, the profit after tax may change. And as the PAT changes, the value for the firm also changes, and therefore it was net income. Okay. Now, let me take you to the next concept, which is also called as, now here we assume that there is no taxes. Let me take you to the next concept, which is called as the net operating income with taxes approach. This is model, Modi-Gilani-Miller model. Okay. Now, in net operating income approach, without taxes, we said value of the levered company will be same as the value of unlevered. In case of net operating income approach, without taxes, we had the conclusion that KO was remaining constant under whatever situation, and therefore the value of the firm will remain constant irrespective of whatever capital structure you choose. Correct? So now net operating income approach, now we are bringing in taxes. We're bringing in tax figure over here. So what will be the impact? The first point I would like to make is, tell me cash flow for a company with debt and compare it with cash flow for a company without debt. Where do you say cash flow is going to be higher? Where do you say cash flow is going to be higher? Will the cash flow for the company with a debt is going to be higher, or will the cash flow for the company without debt is going to be higher? Let me just answer this with the help of an example. Levered means a company with debt. Unlevered means a company without debt. Now let's say we have EBIT. EBIT is going to be same for both the companies. Let's say 10,000. From that, interest is to be deducted. Now interest is going to be a deduction only in case of levered entity. For unlevered entity, there's not going to be any deduction. Interest is, let's say, 4,000. Unlevered, there's no interest. You get profit before tax. Profit before tax is 6,000, and unlevered here it is 10,000. From this, you're going to deduct the tax. Let's say at the rate of 30%. 1,800 and 3,000. Then we have a profit after tax. Let's say here it is 4,200 and 7,000. Now, if you just look at the bank account for both types of companies, what will be the resultant impact? In case of levered entity, EBIT that has been generated by the company, it is an inflow to the company, right? You have EBIT as a debit to the bank account because you'll be receiving 10,000 in your bank after paying for all your variable and fixed expenses. What will be your outflow? Your outflow is going to be interest and taxation and the dividend of 4,200. Correct? So from EBIT, you're paying a tax of 1,800, you're paying an interest of 4,000, and you're paying a dividend of 4,200. Now, if I ask you, what is the payout to fund providers? What is the payout of the company to the fund providers? How much is being paid out by the company to the fund providers? Of course, you are paying interest to the fund provider and dividend to the fund providers. So whoever have invested in your company, you're paying them their required share. You're paying them 4,000 as interest and 4,200 as dividend, which is 8,200. Whereas, if you look at payout to fund providers for the second case, . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . In bank account, you have a EBIT of 10,000. On the other side, you have a tax 3,000, right? And you're going to pay a dividend of 7,000. What is the payout to the fund providers? It's just 7,000 because you're no debt. You don't have any debt. The entire 7,000 is being paid to the fund providers, which is the equity share. So where do you find that payout to the fund providers or cash flow for a company with debt and without debt? Which of these two companies are having a greater degree of cash flows? Of course, cash flow for a company with debt, it is 8,200, whereas cash flow for a company without debt, it is 7,000. Therefore, we can say this is going to be the situation. For a company with debt, cash flow is going to be higher. For a company without debt, cash flow is going to be lower. Now, why am I saying so? Just I would like you to, I like to draw your attention towards the amount of taxation. If you are having debt in your company, because of interest payment, tax is going to be lower. Whereas if you don't have any debt in your business, it is fully, let's say, unlevered, then entire amount of tax is going to be higher than the levered entity. The unlevered entity has got a higher amount of tax payment as compared to the levered entity, right? So if I ask you what is the additional cash flow, to fund providers, is going to be 8,200 minus 7,000, which works out to be 1,200. Now this 1,200 is basically nothing but tax saving on interest. Nothing but tax savings on the interest. You can see what is the tax saving on our interest? Say this 1,800 and 3,000. That's the only difference that we have, right? We can also say that this 1,200 is nothing but whatever interest you are paying, 4,000 on that 30%. So that is 12. So tax savings on interest is 1,200, right? So in case of a levered entity, the entity which has got debt, cash flows are going to be higher due to tax savings, correct? So we say additional cash flow in levered firm is going to be interest multiplied by the tax rate. That's what we did over here, right? 4,000 into 30%. So interest into tax rate is the extra cash flow that is available in a levered form. Now, since there is an extra cash flow in the levered form, what will be the value of this extra cash flow for levered form? What will be the value of extra cash flow for the levered form? Can I say it's going to be simply present value of interest into tax rate? Now, present value of interest into tax rate will be that's going to be interest into tax rate upon KD or cost of debt. Now, if you just divide this interest upon KD is nothing but the value of debt. Value of debt into tax rate. So we say value of levered firm was equal to value of unlevered firm, plus there is going to be an additional benefit out of it. So value of levered firm will be equal to value of unlevered firm plus value of debt into tax rate. Now this is a formula or Modigliani-Miller model, model, and is also called as net operating income with taxes. If we have net operating income with taxes approach, we need to follow this particular form. If it is without taxes, then the value of levered entity and unlevered entity is one and the same. But if it is with the taxes, then we say value of debt multiplied by tax is going to be an additional value for the levered form because of the extra cash flows that it has. Okay. Srinivas sir mentioned assumptions the applicable market is efficient. Perfect. There is an underlying assumption that markets are efficient. Rajendra is asking why you have taken hypothetical rate for equity to 50%, it is 40%. You also remain same. Not then how the rate of risk is determined in such cases. Gajendra Tiwari, again, this is the assumption that we have uh, in this case that as the weightage of debt increases, the KE increases in such a manner that the KO remains constant. From where did the unlevered value come? Last step, okay. This one, see, value of levered will be same as unlevered if it is no tax scenario. But if there is a taxation scenario, then we have this extra cash flow for the levered entity. So that extra cash flow to the levered entity acts as an additional value. Okay, Mamta is asking, sir, I have a question. As debt increases, the interest liability, debt as debt decrease interest liability, but on the other side, it increases the shareholders' expectations. It is the cost of capital. So you're not framing it properly. I'm not able to understand what you're asking. Kanishka is asking, did not understand the last step? From where did the okay? This is the extra cash flow present value. But the levered entity is having normal cash flow as compared to the unlevered form. Like see over here, cash flow for the levered form was 8,200 and cash flow to the unlevered was 7,000. So this extra cash flow to the levered form was 1,200 and present value of all future 1,200 is this. But the company has got the regular cash flow of 7,000 also. And therefore, this is unlevered value. This is present value of 7,000 every year till perpetuity. This is present value of 1,200 till perpetuity. Okay, fine. So enough of theory for the time being. Let us do one thing. Let's take up uh, questions from the handout. We'll take up questions from capital structure theory problem section. Remember, we'll discuss the RTP questions also if time permits today, or we also have a session for revision of the capital structure and ratio. At that time, we will be discussing the RTP questions. Okay, so let's look at question number 1 first. Lakshmi Limited is expecting an annual earnings before payment of interest and tax of rupees 2 lakhs. The company is in capital structure. The company in its capital structure has 8 lakhs in 10% debentures. Cost of equity or capitalization rate is 12.5%. You are required to calculate the value of the firm according to net income approach. Also compute the overall cost of capital. So this company has an expected annual earnings before payment of interest and tax of 2 lakhs. Can you tell me which parameter is this? Is this EBIT or profit after tax? Of course, as the name says, it is earnings before interest and tax. We have got earnings before interest and tax tune of 2 lakh. Further, it states the company in its capital structure has 8 lakh in 10% debentures. Company has got value of debt to be 8 lakh. It's going to cost us, cost of debt is 10%. Cost of equity or capitalization rate is 12.5%. So the next data is cost of equity. is 12.5%. You are required to calculate the value of the firm according to net income approach. Also compute the overall cost of capital. So cost of equity is 12.5%. You are required to calculate the value of the firm according to net income approach. And we have to compute the overall cost of capital. So what do we need? As per the requirement, we need the value of the firm and KO. The requirement is value of firm and overall cost of capital. So how do we go about it? Let's have a look at it. First, we begin with EBIT. We have an EBIT of 2 lakh. From this EBIT, we're going to reduce the interest. Preparing the income statement. Interest of 10% of 8 lakh, which is 80,000. Then we have a profit before tax of 1 lakh 20,000. Profit before tax or PAT of 1 lakh 20,000. Value of equity, we PAT on K, right? Or remember, this PBT is same as our PAT. Value of equity will be PAT upon K. PAT is 1 lakh 20,000 divided by K. K is over here 12.5%. 1 lakh 20,000 divided by 12.5%, which is 9 lakh 60,000. And as per our calculation, the formula value of firm as the formula we had earlier, EBIT on K. EBIT is something which we have, but we don't know. We don't have the overall cost of capital figure, right? So as of now, we cannot use this formula. Let us just keep it aside. But we have one more formula for the value of the firm, which is value of equity plus value of debt. Value of equity plus value of debt. And what's the value of equity is? Value of equity is 9 lakh 60,000 plus value of debt is 8 lakh. Value of equity is 9 lakh 60, value of debt is 8 lakh, and that totals up to 17 lakh 16,000. 17 lakh 60,000. Now let me apply this formula. As the value of the firm is EBIT upon KO, value of the firm is 17 lakh 60,000 is equal to EBIT, which we already know it is 2 lakh, on KO is something that we need to compute. Total cost of capital, can get it as 2 lakh divided by 17 lakh 60,000. 2 lakh divided by 17 lakh 60,000, which is 11.36%. So overall cost of capital is 11.36% is the KO. Right? KO is 11.36%. So that answers our initial question. Lag coming in. Yeah. So that's the answer to the first question. I hope we are all good with this. Perfect. Let's look at question number 2. Let's look at question number 2 is Where we say, assume in the illustration given above, the firm decides to raise further 2 lakhs by the issue of debentures and to issue proceeds thereof to redeem the equity shares. You are required to calculate the value of the firm according to net income approach and also compute the overall cost of capital. So basically, whatever was your value of debt, which is 8 lakh, to that we are going to have additional 2 lakh debt being issued, which is 10 lakh. Now the cost of debt is still 10%. The firm is deciding to raise additional 2 lakhs. The illustration gave the firm decides to raise further 2 lakhs by issue of debentures and to issue proceeds thereof to redeem the equity shares. You are required to calculate the value of the firm according to net income approach and also compute the overall cost of capital. So value of debt, now it was earlier 8 lakhs, now you're increasing it by 2 lakhs. So that comes out to be 10 lakh. But remember, the question says you're issuing debentures and you are redeeming the equity shares. Now, obviously, there is no redemption of equity shares, but what we are talking of is essentially buyback of equity. So by issuing 2 lakh debentures, you are getting the money and utilizing the same money for buyback of the equity shares. So as your capital structure, as your the investment that is there in the business, that is constant. So of course the EBIT figures are also going to be constant. EBIT will be same 2 lakh, but since the value of debt has increased, the interest component is going to be now 1 lakh. So that's going to be 10% of 10 lakh. And you will have the profit before tax be 1 lakh. From that, we deduct the tax. Since there is no taxation, your profit after tax figure is still same as PBT. Now, value of equity will be profit after tax upon K. That's going to be 1 lakh divided by 12.5%, 8 lakh, right? And value of debt, now it is 10 lakh. And then the value of the firm is going to be in total 18 lakhs. Overall cost of capital is EBIT upon value of the firm. So EBIT is 2 lakh upon 18 lakh, and the overall cost of capital is 11.11%. Overall cost of capital is 11.11%. So what we observe is, as the weightage of debt increases, the overall cost of capital is reducing, and that's what we have noted predominantly in the capital structure in the net income approach also, right? Correct, guys? Now, let's look at question number 4 lakh. Sorry, not 4 lakh. Question number 3. Question number 3. Modern Limited is expecting earnings before interest and tax of 4 lakh and belongs to a risk class of 10%. Now, what do you mean by this risk class of 10%? It means overall cost of capital is 10%. You are required to find out the value of the firm and cost of equity capital if it employs 8% debt to the extent of 20%, 35%, or 50% of the total financial requirement of 20 lakhs. So total financial requirement is of 20 lakhs, and we are just going to distribute it or bifurcate it between them. They have given us the overall cost of capital as 10% and 8% to be the cost of debt. And we want to know what is the cost of equity and all such aspects. So they've got weight of debt and weight of equity. Our weight of debt is going to be 20, 35 or 50. Right? So 20, 35 or 50. So weightage of debt is going to be 0.2, 0.35, 0.5, and accordingly, what we can observe is rate of equity is 0.8, 0.65, and 0.5. Overall cost of capital, they have already stated risk class is 10%. It means overall cost of capital KO is a constant figure throughout. That's going to be 10%. Then we have got a EBIT. EBIT is also given in the question to be 4 lakh. EBIT is kept constant at 4 lakh. Okay. Now the next task is what you have to compute. Value of debt will be 20 lakhs multiplied by weightage of debt. This is what you guys have to compute. You have to tell me what will be the PAT figures for each of the combinations. Then you have to tell me what is the value of the firm, which is EBIT on KO. Value of equity will be value of firm minus value of debt, right? And then accordingly, we have to get the K, which is PAT upon value of equity. So value of debt will be 20 lakhs is the total capital employed. Out of that, 20% is debt. So that's going to be uh, 4 lakh. First case, if it's 35%, it means 7 lakh the value of debt, and 10 lakh is the value of debt for third criteria. Now, PAT, we can get it as simply EBIT. PAT is simply whatever is your EBIT minus interest. So, which will be like 4 lakh is the EBIT minus 4 lakh value of debt into interest of cost of debt. Cost of debt is 8%. 4 lakh into 8%. So that will be like 3 lakh 68,000. Same way for the second scenario, it will be 3 lakh 44,000. And for the last scenario, it will be 3 lakh 20,000, which will be 4 lakh minus 10 lakh into 8%. So obviously, value of the firm we can arrive at by simply taking the ratio of 4 lakh, which is EBIT, divided by 10%, which is 40 lakh. Then this is 4 lakh. In fact, value of the firm is going to be a constant figure you can have in any combination of debt and equity. Value of firm is same, 40 lakh. What is going to differ is the value of equity, because it is going to be 40 lakh minus the value of debt, which is 4 lakh in first case. This works out to be 36 lakh. Then 40 lakh in the first case minus value of debt is 7 lakh in the second case, which is making the value of equity as 33 lakhs. Then it is 40 lakh minus 10 lakh as the value of debt, which is 30 lakhs. The value of equity works out to be 36 lakh, 33 lakh, and 30 lakh. Now, KE will be PAT upon value of equity. So we already know the PAT figures, 3 lakh 68,000 divided by 36 lakh. That will give you a PAT of 10.22%. For next, it is 10.42, and for the last one, it is 10. This is same as what we have observed in our theoretical justification of net income. Okay. Fine. So that is question number 3, what we have done. For subsequent questions, we will take a short break right now. Let's take a break of 10 minutes. Post that, we'll come up with a few questions. And after that, we will take up the remaining theories. We have done net income, we have done net operating income, and net operating income with taxes. What we are left out is the traditional approach and Modigliani and Miller approach without taxes. We'll see both these theories along with some more questions post break. Let's take a break, guys. See you in some time very soon. Hey, welcome back after the break. Bhumika is asking what is the arbitrage process? Arbitrage process is there yet to be discussed. We haven't discussed that. Okay, now let's go for next question. We touch upon the remaining theories. Um, let's go to question number 12, guys. Yeah, question number 12. Yeah, question number 12. The following data relate to two companies belonging to the same risk class. Same risk class means their operating risk and their basically overall cost of capital and all is just similar. Following data related to two companies belonging to the same risk class. Expected net operating income is 18 lakh for both. 12% debt is 54 lakh. Equity capitalization rate is 18%. We are required to determine the total market value, equity capitalization rate, and weighted average cost of capital for each company, assuming no taxes as per approach, and also total market value, equity capitalization, and weighted average cost of capital of each company, assuming 40% tax. So there are two cases in this question. One is to solve it without taxes, and second is to solve it with the effect of having taxation in the regime. First, let us solve it by the scenario, or in the first case as no taxes. No taxes. So if there are no taxes, let's prepare first the income statement. Let's first prepare the income statement for A and B. Let's begin with the income, expected net operating income. Net operating income is basically your EBIT. So EBIT for both the entities is 18 lakhs. But entity A has got a loan, it has got a debt in its capital structure, B has got no debt. From EBIT, we are going to subtract the interest. Interest is, let's say, 12%. Now, 12% of 54 lakhs. Interest is 12% of 54 lakhs. So 12% of 54 lakhs is 6 lakh 48,000. We get a profit before tax. Profit before tax of 11 lakh 52,000. This is 10 lakh. Now, since there is no tax, can I say our tax amounts will be nil? Tax amounts will be nil, and profit after tax will be 11 lakh 52,000 and 18 lakh. Now, with other information, cost of equity is something that's uh, not given to us. Cost of equity is something that's not given to us. Yes, they have stated that equity capitalization for B it is 18%. Cost of equity for this case for A is not specified, but for B it is 18%. Cost of debt for A it is 12%, and for B it's not applicable at all because it doesn't have any no debt at all. Then the overall cost of capital, KO. KO again not specified over here. But for the second case, since it is all equity, 18%, whatever is a K, that itself is the KO. Okay. Now we have to compute the value of the firm, value of equity, overall cost of capital, cost of equity, and all other aspects. From this, what you can observe is 18 lakh is the PAT and 18% is the KO. We can definitely get the value of the entire business firm, or value of equity also we can get. So for the company B, value of firm will be simply 18 lakh divided by 18%. Value of firm will be 18 lakh divided by 18%, which is simply 18 lakh divided by 18% is 1 crore. Okay. There's no debt in the company. So entire equity value is same as its firm value. So value of firm will be same as its value of equity. So that's 1 lakh, sorry, 1 crore. Now, since we are saying it's a net operating income approach or approach without taxes, in the absence of any taxes, value of the firm, be it levered or unlevered, it is going to remain same. So we can very safely say that this 1 crore is also going to be the value of company A. 1 crore is also going to be the value of company A, as we are assuming it to be model without taxes, right? So it is going to be remaining same since you're assuming it to be model without taxes. What about the value of debt? Well, the value of debt is something that we know already in the question. We already have the value of debt to be 54 lakhs. Let's write down the value of debt as 54 lakh. Now, of course, the value of equity is going to be the value of the firm minus value of the debt, which is value of equity is 46 lakh. Okay, so value of equity is 46 lakhs. That's where the difference we observe. Now, of course, we need to compute also the cost of equity and overall cost of capital. Now, we can get the cost of equity simply by taking PAT upon value of equity. And overall cost of capital will be EBIT upon value of the firm. Right? Overall cost of capital will be EBIT upon value of the firm. So now, cost of equity for the first company is PAT of 11,52,000. PAT of 11,52,000 divided by value of equity. We arrived it as 46. So that translates to percentage of 25.04. And overall cost of capital is going to be 18 lakh divided by 1 crore, which is 18. Total cost of capital is 18. I hope this makes sense to everyone. I'd like to give you just a minute's time to go through the solution quickly. Please go through the solution quickly, guys. Then we can go for the next case wherein we are getting the tax involved. Please go through it just within a minute so that we can look at the next scenario wherein taxes are applicable. Hope it's clear. This first part wherein no taxes are involved. Is it clear to everyone? Then we can go for the next part, which is getting involved the taxes. Sahil is asking what is retired debt. Sahil, retired debt means repayment of debt. Okay, clear? Fine. Then let's go for the next scenario, wherein we have got the tax rates getting involved. So do we, as we have taxes, value of the firms cannot be same, right? Now, looking at the second case, case two. Case two is with the taxes. Case two is with taxes. So let's first prepare the income statement. Now the income statement is to be, and the data is going to be on the similar lines. Just the tax is going to come into picture. So we have got a EBIT of 18 lakh, interest of 6 lakh 48,000. We have a PBT, but since we have tax area now, since we have tax, we need to get the tax amount by multiplying the PBT with the rate of tax. Now, what is the rate of tax specified in the question? Rate of tax is 40%. Tax has to be computed at the rate of 40%. So on 11 lakh 52,000, 40% works out to be 4 lakh 60,800. And for B, using the tax rate of 40%, we can get the tax amount as 7 lakh 20. Of course, the PAT figures accordingly will be the subtraction. Yeah, so subtraction, it will be 6 lakh 91,200, and then it is 10 lakh 80,000. Uh, the remaining data remains the same. Based on this, let's look at so we are writing down the same parameters what we had written over here. Value of equity, KE, KD, and KO is what we have been known. Now we have the other calculation, which is the value of the firm, value of the debt, and then the value of the equity. Now, as far as value of the firm is considered, or value of equity is considered over here, well, the value of equity in this case will be same as the value of the firm, because the nil amount is for the value of the debt for company B. For company B, there is no value of debt. For company B, there is no value of debt, and therefore it will be nil. Whatever is the value of the equity, that itself will be the value of the firm. So to get the value of the firm, we first let's compute the value of equity. Value of equity, we are computing it as whatever is our PAT, which is 10,80,000 divided by K. 10,80,000 divided by K of 18%. 10,80,000 divided by 18% is 60 lakh, and that itself is going to be the value of the firm. By the way, remember over here, whenever we have taxes, value of the firm, whenever we have taxes, value of the firm is computed as same as value of equity in case of a unlevered entity. Now, how do we go about the levered entity calculation? Because here we do have the value of debt available. Value of debt is 54 lakhs. Value of debt we have over here is 54 lakhs. But then how do we get this value of equity and the value of firm? How do we get this value of equity and the value of the firm? Typically, we are looking at the value of the firm calculation. Remember, value of levered entity was value of unlevered plus debt into tax rate. Over here, it's going to be 60 lakh plus value of debt is 54 lakh. That 54 lakh multiplied by tax rate of 40%. 60 lakh plus 54 lakh into 0.4%. That will give us the answer as 81 lakh 60,000. So value of the firm is 81 lakh 60,000, and already the value of debt is 54 lakh. So we can obviously get the value of equity to be the difference between them, which is 81 lakh 60,000 minus 54 lakh. That makes us the value of equity as 27 lakh 60,000. So essentially what we did first is we got the value of the equity first, right? So if I just keep on numbering, this is what we did first. Second, we did the calculation for the value of firm of the unlevered entity. Third, we did the calculation of the value of levered entity. And finally, value of the equity for the levered entity. Okay. Fine. So now we can talk of cost of equity is simply going to be PAT upon value of equity. So PAT is 6,91,200 upon value of equity is 27 lakh is 25.04%. Overall cost of capital is computed as EBIT into 1 minus T upon value of the firm. By the way, this is the formula applicable if taxes are applicable. If we have taxes, then the overall cost of capital formula changes. Make it a after tax figure. We take it as EBIT 1 minus T. So EBIT is 18 lakh into 1 minus 0.4 upon value of firm is 81 lakh 60,000, which is 13 point. By the way, one more way of computing this overall cost of capital is you can do it by using the weighted average cost of capital method also. Okay, so that's how we solve this with taxes questions. How these two companies are of same risk where the finance risk is different. We are talking of one is the operating risk. Operating risk for both the companies are same. That is the assumption. Finance risk is obviously different. Okay. Now let us take next area of discussion, which is about the next theory rather, traditional approach. We have covered the net income approach, net operating income approach, and net operating income approach with taxes, which is a model. Now we're looking for the traditional approach. Now this traditional approach is simply understood as a combination of two set of theories. Let's have a look at it. See, in this traditional approach, the level at which the borrowings are taken are classified into three stages. In the very first stage, a smaller amount of debt is taken. As the proportion of debt increases, the debt funding enters the second area and then finally the third area. In the first phase, as far as traditional approach is concerned, uh, by the way, this is weightage of debt. In the first phase, we say uh, that the company borrows some smaller amount of debt. And if the company is borrowing some smaller amount of debt, that is essentially not going to have any impact on cost of debt of the company and neither on the cost of equity. Ideally, whatever is your cost of equity, that's going to be a higher figure. Cost of debt is going to be a lower figure. So cost of equity on a higher end, cost of debt on lower end, and for up to this level, maybe up to 5% or 10% of the total capital, the company can borrow money. That's not going to trigger our equity shareholders to start demanding for a higher return. So equity shareholders are keeping their required return constant. Cost of debt is also constant. But what is going to happen to the overall cost of capital? What's going to happen to the overall cost of capital? Of course, it's going to have a downfall. Overall cost of capital is going to have a downfall. K is constant, KD is constant, and overall cost of capital is facing a down. Overall cost of capital is going down. Okay. Uh, this is typically a case of net income approach. So this theory says that for smaller amount of debt, maybe 5% or 10% or maybe 15% of the total capital, smaller amount of debt is not going to trigger our equity shareholders to ask for a higher rate of return. They are still satisfied with what the company is offering them. And therefore, their required rate of return is constant and KD is constant, but overall cost of capital will start sliding down. But beyond a particular limit, now equity shareholders will start demanding a higher. Beyond a particular limit, equity shareholders will start demanding a higher return. And now the equity shareholders start raising their required return because a risk is arising to them because of the debt taken by the company. As the company goes for borrowing, the risk for the company increases, and so does it increase for the equity shareholders. And therefore, equity shareholders start demanding for a higher returns. Now, the overall, the cost of debt is still at a lower level because bankers are comfortable providing you funding up to maybe 50 or 60% of your total capital. So they would not charge you essentially higher. Now, what will happen to KO? The KO which was sliding down, now it will become a constant figure because there is a upward pull due to higher K and there is a downward pull also due to lower KD. So KO is going to become a constant term over here. So this phase is similar to what we have discussed as net operating income. This phase is similar to net operating income. Okay. Now, after this net operating income approach has reached, if the company starts borrowing beyond this, let's say company wants to borrow more than 70% of the total capital employed, obviously the bankers are not dumb. They will start demanding a higher rate of return, and that will finally lead to increase in the overall cost of capital also. So which is the best capital structure phase? Can I say the best phase is this, the second phase, wherein uh, the overall cost of capital is minimum because below that overall cost of capital is higher, and beyond that also overall cost of capital is. So this is basically a combination of net income and net operating income approach. So now let me just look at a typical question I have over here. Okay. Let's look at question number 4. Ganesh Limited is expecting an EBIT of 3 lakh. Is having an EBIT of 3 lakh. The company presently raised its entire fund requirement of 20 lakhs by way of issue of equity shares at a capitalization rate of 16%. The firm is now contemplating to redeem a part of capital by introducing debt finance. The firm has two options, either to raise debt to the extent of 30% or 50% of total funds. It is expected that for a debt financing up to 30%, rate of interest will be 10% and equity capitalization rate is increased to 17%. However, if the firm opts for 50% debt, then the interest rate will be 12% and equity capitalization rate will be 20%. You are required to compute the value of the firm and its overall cost of capital under different options. There are two options which the company has got based on the weightage of debt. If your weightage of debt is 0.3 or 0.5, then the cost of debt will be 10%. And if the firm opts for 50% debt, then the cost of debt will be 12%. And accordingly, the K is also different. K is for equity capitalization for 10%, it is 17. And if it is 50% debt, then this is 20% is the K. Okay. So we have a constant EBIT anyways. EBIT is common. EBIT works out to be 3 lakh. Now what we want is we want to compute what will be the value of the firm and overall cost of capital under different options. So if this is the EBIT, we need to first get the interest amount. Interest amount will be fund requirement of 20 lakhs. So out of 20 lakh, if your 30% is debt, you can say it is 20 lakh into 30% is debt. And on that, you are paying an interest of 10%. That works out to be a interest amount of 20 lakh and 10%, which is 60,000. And the next case, it is 20 lakh into 50% into 10%. 50% into 10%, which is 1 lakh. The interest, now we can get the profit before tax or PAT because no taxes are given over here. That will be 2,40,000 and 2 lakh. 3 lakh minus 60,000, that's 2,40,000, and 3 lakh minus 1 lakh, that is 2 lakh. Tax or profit after tax figure of 40 and 2. Now, based on this, we can get the value of equity. We simply PAT divided by K, which is 2,40,000 divided by 17%. That 40,000 divided by 17% is 14,11,765, and 2 lakh divided by 20% is 10 lakh. Then the value of the firm will be simply, value of equity plus value of the debt. Value of equity is 14,11,765 plus value of debt is 6 lakh in the first case, and this is 10 lakh plus value of debt will be 10 lakh. This totals up to 20,11,765, and this is 20 lakhs. Right? So which is the best scenario? Where do we get the highest value? Highest value is over here. Therefore, company should go for a weighted average debt of, debt amount not exceeding 30% of the capital. So because ultimately our objective is to maximize the value of your company. Value of the company, whichever option is the maximum, that's what we are going to choose. The second case, it will be, oh, my bad. This is 12%, correct? So if this is 12%, means it is 1,20,000. EBT will be 1,80,000. Right? This number is also going to be like 1,80,000. Like 80,000 divided by 20%. This is 9 lakh. This works out to be 9 lakh plus 10 lakh, so totaling up to 19 lakhs, correct? So the decision remains the same, that you should be funding it by way of 30% debt and not more than that, because that ensures that you have got the highest value for your business. Now there's a concept of Modigliani-Miller arbitrage. That's the last part we are going to discuss today. Let's take up that case of Modigliani-Miller arbitrage. Now that arbitrage, we are going to learn it. Question number, in question 6. We're going to learn the arbitrage in question number 6. See, in our essential first part, what we have discussed is there are two set of theories. One set of theories says that value of the firm remains constant. The other set of theories says value of the firm will differ according to the capital structure. So now the the way of approaching or the way of answering that, what we have seen is net operating income and net income approach, is to look at the impact of having more debt in your overall cost of capital, and then what will be the resultant impact on the value of the firm. Another approach was adopted by these two financial economists called as Modigliani and Miller. They explained that the value of two firms will remain constant irrespective of the capital structure adopted by them in the absence of taxes by an arbitrage concept. Before I go to this arbitrage, this type of question, I would like to know what is arbitrage. Have you heard of this term arbitrage earlier? Have you heard of this term arbitrage earlier? What is arbitrage, by the way? Arbitrage is basically taking advantage of price differential of two different markets. So let's say we have got NSE and BSE, two stock exchanges. In NSE, the price of the share is, let's say, 1100. And in BSE, the price of the share is, let's say, 1105. As a rational investor, as a rational person, what will be your course of action as soon as you see these prices? As soon as you see these prices, what will be your course of action? Yeah, guys, tell me. As soon as you see these prices, what will be your course of action? What actions would you take by looking at these prices? Obviously, we are going to buy from NSE and sell the same in the BSE, correct? Because that will make me a risk-free profit of 5. It will ensure me a risk-free profit of 5 rupees because buying at 1100 and we are selling it at 1105. That's what is arbitrage all about, right? So basically, arbitrage is what? Buy in the cheap market and sell in the pricey market. We are going to buy the product or buy the share in the market where it is selling at a cheaper price, and we'll sell it in the market where the price is higher. A similar arbitrage concept will be undertaken in case of companies also, because investors will switch from one company to another company. Investors are going to switch from one company to another company by looking at the arbitrage possibility. Now, remember, when you're switching from one company to another company, and if you're getting higher return because of higher risk undertaken, if you're getting higher return because of higher risk undertaken, then if you're getting higher return for higher risk undertaken, then it is not regarded as arbitrage. Arbitrage is you are getting higher return for the same level of risk. This is what you just need to keep in your mind. Just remember, what do you mean by arbitrage? Arbitrage is getting risk-free return. Risk-free return means you're getting a return which is definitely positive, but it is risk-free without any risk. Or you can say it was having the same risk as you were facing earlier. No change in the risk profile. Then only you will say it as arbitrage. Because otherwise, if you take high return, high risk, definitely you'll be able to get a higher amount of returns. Okay, so now let's look at this question 6 and understand how this arbitrage is going to work. So there are two companies, U and L. There are two companies, U and L. U is a unlevered entity, as they have named it, and L is a levered entity. Okay. Then, as far as the information is concerned, company L has 20 lakh of 8% debentures outstanding. So L is a levered entity. It has got a certain amount of debt. Company L has got 20 lakh of 8% debentures outstanding. Assume that all the assumptions are met, that the tax rate is 35% and EBIT is 6 lakh, and that equity capitalization rate for company U is 10%. Companies U and L are identical in every respect, except that U is a unlevered and L is a levered entity. Company L has 20 lakh of 8% debentures outstanding. Company L has 20 lakh of 8% debentures outstanding. Now, obviously, debt at the rate of 8%. Tax rate is 35%. EBIT of 6 lakh, equity capitalization rate is 10%. To understand this arbitrage, the assumption that we have is no taxation. So we are not considering the taxation as such. But yes, EBIT of 6 lakh and equity capitalization of U is 10%. Basically, K of this is 10%. K of L is something which we don't know, but we know the EBIT. EBIT will be 6 lakh. 6 lakh in. Uh, as far as unlevered entity is concerned, whatever is the cost of equity, that same is going to be the overall cost of capital, right? Because there's no debt, K and KO is going to remain same. K and KO is going to remain same. And they further say uh, K is same 10%. But yes, KD is given in the question as 8% for company L because it has got a debt at 8%. Now, if I ask you what will be the value of the firm, value of the firm will be EBIT of 6 lakh divided by KO of 10%. It means here the value of the firm is 60 lakh. Now, what should be the KE or what should be the KO for the levered firm? Let's look at it for as far as the levered firm is concerned. Um, value of equity will be same as this, and this is same as our value of firm as such. Now, let's say KE, for example, for levered entity, since it is levered, the cost of overall cost of equity is going, the cost of equity is going to be higher. Now, let me take it as 12% maybe. Let's say this is 12%. Yours. Just creating a scenario for arbitrage right now. So here the value of equity will be, no, I cannot just take this as EBIT because for value of equity, we need the profit after tax. From this, we subtract interest, still in this case. And the second case for the levered entity, interest is going to be 8% of 20 lakh, which is 1 lakh 60,000. PBT is 6 lakh and 6 lakh minus 1 lakh 60,000 will be 4 lakh 40,000. And value of equity is going to be 4 lakh 40,000 divided by 12%. Just check what is the value of equity. 4 lakh 40,000 divided by 12% is 36 lakh 66 667. Value of debt over here it is nil. On the other side it is 20 lakhs. So value of the firm The unlevered entity has got a value of 60 lakh, whereas the levered entity has got a value of 56 lakh 66,667. Now, out of these two entities, can you tell me which entity is having a higher valuation and which one is having a lower valuation? Obviously, the unlevered entity has got a higher valuation and the levered entity is having a lesser valuation. The unlevered entity is having a higher valuation, levered entity is having a lower valuation. Now, our investor will buy shares of which company and will sell shares of which company. Remember this concept. Will buy in the cheap market and sell it in the pricey market. So since this is pricey, this is going to be sell, and the arbitrage strategy will be to sell the shares in the unlevered entity and buy the shares of the levered entity, because you're simply following the arbitrage policy. The arbitrage policy says you should be selling the shares of high value company and buying the shares of low value. Now, why would I like to really do that? Why would I really buy the shares of a low valued company? Because there may be some benefit. So let us see if there's some benefit possible or not. So let us assume an investor with 10% stake in, just assume an investor with a 10% stake in Q. Now the first step is to sell shares of U. Can you tell me what will be the realization by uh, selling the shares of U? What will be the realization? How much amount are we going to get when we sell the shares of U? Since we have 10% stake, it is going to be 10% of value of equity of company U is 60 lakh into 10%. So 60 lakh into 10% will give you a realization of 6 lakh. What are we going to do with this 6 lakh that we received on selling shares of U? When we are selling the shares of U, what are we going to do with that amount of 6 lakh? We will obviously invest this amount in the levered entity. So the second scene is we will say buy 10% stake in levered entity by investing 10% in equity shares. So by investing 10% in equity shares means it's 10% of 60 lakh, right? So by investing 10% of equity shares, not 60 lakh, my bad. 10% of 36 lakh 66 667. So you are actually paying 3 lakh 66 667 to get 10% stake. But since we are going to invest in the invest in the shares of L company, there the company has got a debt. Do you mean to say that the risk which we had by investing in U, is it same as investing in L? No, it's not same, because U was fully equity company, whereas this is a debt and a equity company. So I just need not buy 10% of equity shares, but also I will buy 10% stake in debt of L. So 10% stake in debt of L, it means going to be 10% of 20 lakh, which means I'm going to invest additionally 2 lakh. So total investment that we made is 5 lakh 66 667. By selling the shares of you, we received 6 lakh. By selling the shares of you, we received 6 lakh. Now, utilize that 6 lakh to invest in equity shares and also invest in the debt of the company. And there we are spending 5 lakh 66, 667. Still, we have got some surplus cash. Surplus cash is out of 6 lakh, we spent 5 lakh 66, 667. And we still have the surplus of 33,333. Still have the surplus of 33,333 as a surplus cash available in our account. Let us see what is our income. What was our income earlier and what is our income now? Income in U and in L. So in U, we had a share in the profit after tax. In U, the profit after tax was, or profit before tax, it was 6 lakh. We had a share as 6 lakh into 10%, which is 60,000. Now, when you have invested in L, we will be having a 10% share of this 4 lakh 40. So 4 lakh 40,000 into 10%, which is 44,000 is the share in the PAT. We also have share in debenture interest in the current scenario, which we didn't have in the earlier when we were invested in U. Right? The share in debt interest, the total interest that the company is going to pay is 1,60,000. So out of that 1,60,000, we have got a 10% stake, which is 16,000. So of course, total income, earlier also it was 60,000. Now also it is 16. Earlier it was 60,000 and now even the total income is same 60,000. So what has changed, sir? The thing that has changed is your investment. Remember, you were earning this 60,000 earlier by having 6 lakh invested in the shares. Now you are earning 60,000 by investing just 5 lakh 66, 667. Or I can say their investment amount is getting reduced by 33,333. Or rather, we can say as an investor, will also receive some interest on surplus, is 33,333 into some X%. Some X% of this 33,333 is what you're going to earn in excess, which you were not earning earlier over here. Now, what's going to happen? Many investors who are invested in the unlevered entity will start selling their shares. Many investors who were invested in the unlevered, they'll start selling the shares and move their investment towards debenture and shares of company L, which will ensure that they are earning something more than 60,000. And this is where the arbitrage process will go on. And what will happen in the long run? The shares of company U, price of the company U shares will start falling and price of company L shares will start increasing, and resultant impact will be value of firm of unlevered entity will fall and for levered entity will increase. Are we able to get it? Yeah. That's how the arbitrage process works. Yeah. So do we have any query? Let me just see if there are any. Last 5 minutes, we can just look at the queries. Arbitrage process, what we have done right now. Let's bringing this capital structure to an end. We'll do some more discussion about capital structure probably in the subsequent vision class that we have on the Saturday. Any queries, guys? Uh, Jay Ganesh is asking, do we need to study theory for only MCQ, or there is a chance of asking theory questions in exam? You can get theory questions in exams also. It's not limited to when MCQs need not be only theoretical. It can be even practical oriented. Like you may have the calculations also coming. Any other queries, guys? Or shall we call it a day? No queries? Nothing? Just wait for pay, maybe probably a minute. Then call it a day if there are no queries. Right? Why did you took debt to invest? Because okay, here you are asking why do you take debt to invest? Because earlier my entire investment was in the company which was fully equity. Now my investment goes into a company which is having debt also. So to remove that risk of debt on the company, I invested in the debt of the company. Because if I'm only a equity shareholder, I'm having the risk that if the company doesn't perform, the equity shareholder, the debt holders can come and take the assets of the company. To avoid that, I myself become a debt investor. Okay, fine. So let's just stop here for the day in that case. Uh, see you guys. You in the next class. Bye bye. Take care. Over, sir.